Okay, so today we are going to continue our series on financial planning workshop, and we'll be talking about investment planning. You know, most people, especially DIY people, do it yourself. They just feel that when it comes to investing, all they need to do is just go ahead, go to their brokerage app, buy stock, sell. That's all they need to do. But the most successful people actually have a plan. You know that saying, remember that saying that to fail to plan is to plan to fail. So that applies in every endeavor, in everything you do, even in investment. You actually create a plan. You decide, like, okay, why do you want to invest? What are your goals and things like that? Then you carry out the plan. Now, let's look at why investment planning matters. There are so many reasons, and this is not an exhaustive list. When you plan for investment, you are able to grow your wealth, you are able to reach your financial goals, you are able to manage your risk, maximize potential return, stay ahead of inflation, you are able to invest more tax efficiently, and you avoid emotional investing, you stay ahead, or you stay on track through markets ups and down, then you benefit from long-term compounding and you prepare for retirement with confidence. Having said that, what are some common investment types? They're like stocks, bonds, mutual funds and ETFs, real estate, precious metals, and alternative investment. Alternative investment includes things like cryptos and so on. And again, this is not an exhaustive list. These are just some common things that you can invest in. Most of while everything I'm going to talk about today applies to the different investment types, I will focus more on stocks, bond, and mutual funds, and ETF, of course. So now, one of the first things you need to plan when planning your investment is risk. I always tell people that when you invest, there are risks associated with investment. If you are not able to take risk, then investment is not for you. Maybe you need to put your money in the bank. Maybe you need to get IE savings account or something rather than buying stocks, rather than buying bonds. But if you choose to invest in the stock market, there is an associated risk, and the risk is unavoidable. While you can minimize the impact of the risk in your portfolio, but you cannot rid of the risk at all. So there are so many things, so many approaches you can use to minimize your risk. And before you even go into the issue of minimizing risk, let me just talk briefly about the different types of risk when it comes to investing. There is the market risk, the risk that, okay, the entire market is going to go down. There is inflation risk, the risk that inflation, your investment will not meet up with the inflation. For example, you put $100 in a savings account for 1 year. After 1 year, you still have $100, but the $100 does not have the same value it had a year ago when you put it in the bank because of the inflation, right? There's interest risk, the risk that by the time you want to um invest, maybe the interest rate has gone up or gone down. There's credit risk, liquidity risk, and longevity risk. But we're going to focus more on how to reduce the risk or for your portfolio. But before we go into that, one thing that will determine the level of risk you are able to take is to create an investment goal. You don't just invest because somebody advised you to invest. Why do you want to invest? What are your goals? Your goals will determine the type of risk you are able to take. And an example is this. For me, I'm investing to build wealth and I'm also investing for retirement. Because I'm investing for retirement, which is not coming in the next 20 years, I'm able to take a lot of risk. In actual fact, my portfolio, some of my, I have different brokerage accounts, but some of them have like 90% stocks because I know I don't need the money now. I don't need the money in 10 years. So I'm able to take risk. But for somebody else that needs the money in, let's say, in 2 years, they cannot afford to take the kind of risk that I'm taking. In actual fact, um, one of the things at Ivorian Financial, when we get a new client, one of the things we try to determine is their risk level. So, and also their goals. Their goals will determine the risk. Then the next thing is the risk tolerance. How much risk are you willing to take or are you able to take? You don't want to invest in something that will keep you up at night. Let's say the market is not doing well and you're waking up at night because of your investment. You don't want to do that. That's why for me, even though I know that cryptos are good and a lot of people make money in cryptos, I don't do it because it's too volatile for me, you know. So yeah, it's important to determine your risk tolerance. Again, at Ivorian Financial, when we meet new clients, we ask them questions about their risk tolerance before we even start to invest for them. We determine what level of risk are they able to take. We don't want them to wake up at night. We don't want them to be thinking um to be to panic when there is a drop, you know. So that's really important. The next thing is risk capacity. Most of the time, people confuse risk tolerance and risk capacity. While tolerance is more of like a behavioral or like a mindset, the risk capacity is your ability to your what's it called? It's about money, your finances. Do you have the financial capability to be able to tolerate risk? You know, so it's measured by the capital cushion that you have. It's measured by like, okay, the timeline that you have. For example, in within a longer time horizon, you're able to take more risk, right? So it's measured by different things. Then the next thing is risk versus return. Like I told you, when it comes to investing, there's risk associated with it. While you can be able to reduce the impact of the risk, you cannot eliminate it. Now, one important thing is that the more risk you take, the more the returns or the potential returns. For so many people, they don't want to take risk, and at the same time, they want to get a lot of returns. It doesn't work that way. That's why I have this chart here. There's always a trade-off between risk and return. If you want to get more return, you have to take higher risk. And I have this line here: when you are not willing to take high risk, when you have a low risk tolerance, then your return is likely to be lower. When you want to take moderate risk, and this could be like, okay, maybe putting your cash in the bank or buying like CDs or so, then you may want to take have a balanced what's it called risk. Like, okay, take a little bit of risk. You have higher return than taking low risk, right? But if you also want to, if you're the person that is able to take a lot of risk, then your return is high. And if you have the highest risk tolerance, then you have the highest potential return. So this should be a guiding principle for anybody that wants to invest. And it's not just the stock market. Any kind of investment that you want to embark on, if you're able to take higher risk, then there's a higher potential return. If you're not able to take risk, there's a lower potential return. Now, another important thing to look at when you want to invest is the asset allocation. What exactly do you want to invest in? I talked earlier in one of the previous slides about the different investment types: stocks, bonds, real estate, and all of those things. So Are you putting all your money in one investment, which is not a good idea? You know, that's saying that you don't want to put all your eggs in one basket. For me, even though I said I have like 90% of my investment in the stock market, I also have bonds as well. In the past, I've had CDs as well. In actual fact, I still have CD right now. So you want to be able to determine what asset allocation fits your needs based on your goals, based on your risk tolerance. And because of that, you're able to allocate your funds into the different asset classes that fits your needs. Now, I'm going to start with strategic asset allocation, which is more of like a long-term roadmap. Basically, you are able to set your baseline mix of stocks, bonds, and some other asset class. The most common asset allocation is like people will say, okay, 60% stocks, uh, uh, 30% bonds, that's 90%, maybe the remaining 10% in cash or cash like assets, maybe like CDs, right? Some other people will do 60-40, 60% stock, 40% bond. The most important, it doesn't matter the percentage, you know. So like I said, some of us have up to like 90% of stock. The most important thing is that just make sure that whatever asset mix that you have decided to leverage fits your needs. You don't want to get 70% invest, let's say 90% of your funds in the stock market when you need it the next year. No, you want to put more in an asset that you can easily liquidate and it's not that volatile. Then for tactical asset management is more of short-term use. When you have determined that maybe a particular asset class is going to appreciate a lot. So you can temporarily reallocate part of your money, more of your funds into that asset class so that you can be able to partake of the gain that you envisage is going to come out of it. That's tactical asset allocation. Then diversification. This is very, very important. It ensures you have like ultimate safety net. Diversification means that again, you don't put all your eggs in one basket. You put your funds in different asset classes that have different levels of volatility. For example, you can put some in stocks, put some in bonds. Even within stocks, maybe some of your funds will go into like mutual funds, ETFs that are like baskets of stocks, right? And some could also be individual stocks as well. And also, one of the things that some people fail to realize is that many, let me not say many, I take that back. Some of the mutual funds and ETFs out there, they are not very well diversified. Some people automatically think that okay, once they buy ETF or mutual fund, they are diversified. Not necessarily. When you look at some mutual funds, some ETFs, they have a lot of concentration. Maybe like 50% uh of their stocks is in 10 or even 5 companies. While that is a little bit diversified, it's not well diversified. So you're one of the things when you're investing in a fund, one of the things you need to check is the companies that are in the fund and the allocation of each company to determine whether or not that fund is good for you. Then diversification could also be in terms of geographical location. You don't want to buy only companies in the United States. You want to buy foreign companies as well. Emerging companies, emerging countries, developed countries as well. Many times, some of them actually perform better than local companies. Another thing when it comes to diversification is also diversification between industries. Maybe you have invested in oil and gas. Maybe you want to do a little bit of real estate, a little bit of banks as well, a little bit of tech as well, so that when one industry is not doing well, another industry will do well. Correlation. This is something that many DIY investors don't even look at. Correlation talks about how different stocks in your portfolio move along together. If you have a portfolio and let's say you have a portfolio of 10 stocks and five of them move in the same direction, that's not good enough. Correlation basically talks about the degree of movement, like, okay, as one is going up, is the other stock going up or is it going down as well? If time permits, at the end of the session today, I'm going to show you. We're going to have like we're going to look at a portfolio. We'll see the correlation of the different stocks in the portfolio. The last item here is rebalancing. When you have determined your asset allocation, again, let's say you want to do 60-40. There are times that some of the stocks will perform better than the other, and that may actually change your asset allocation. By the time you have noticed that your asset allocation is changed, you want to rebalance. The rebalance basically means that you are selling your winners, you are buying more of the losers, just to make sure that your asset allocation uh, remains consistent with your goals and your risk tolerance. Now, behavioral finance. I always my sister is an investor, so and many times I joke, or when we're joking, I always say that investors are not rational. You know, and when I say investors, I mean every one of us, including myself. There are times that you expect certain things to happen and they don't happen. There are times that a company releases their what's it called? Their result, the quarterly report, and everything is so good. The revenue has increased, the earning per share is good and everything. Yet the stock goes down. There are things you need to look at, and that could help you in investing. Number one thing I have here is panic selling. This is something you need to avoid by all means if you want to be a successful investor. I have this chart here. This is the performance of S&P 500 in 2026 from January 1 till June. If look at how, like, I believe that was because of tariff or something in March, the stock market went down. If you panicked at this time and you sold your stock, by the time this market recovered, you would not have been able to participate. So panic selling is something you need to avoid by all means. And I'll tell people the money you need. Even last Sunday, I was still telling one of my clients that wanted to add more money to his portfolio, and he was telling me that okay, he needed the funds for certain things. I told him, if you need the money within 1 year, I'm not going to invest it for you. Rather than investing in stock, maybe I can help you put it in CDs and bonds. But I'm not going to put anything you need within 1 year. I'm not going to put it in the stock market. Why do I have that principle? Not just for myself, but also for my client, because I want to avoid panic selling. When you need money within a short time and you see that it's going down, you might want to panic and sell it so that you don't lose too much money. But when it's the money you don't need within a short time, you are able to still stay in the market. The best thing you want to do is to stay in the market when the market is not doing well. And in actual fact, I use this analogy. When you buy something often, if your best let's say watch or whatever is on sale, you buy more of it, right? Why is it that people sell their stocks when the market goes down? So this is really, really important that you don't sell when, or you don't panic when the stock market goes down. The one thing you need to know is that the stock market never moves in a straight line. It goes up and down. When it goes down, that's the time to buy more when you have more money. And then by the time it comes back up, you're able to get more the return. So even with all the ups and downs and everything, if you look at the straight line, if you smoothing the performance, From January to June, the stock market has still performed 8.4%. If you look at it to July, it's about 9 point something percent. The other thing is market timing. Again, this can also be used to explain it. Some people will think that, okay, when the market is going down like this, they will sell it, thinking that they will be able to time when it reaches the bottom, they will buy back. It doesn't always work. Nobody can tell you when the stock market is going to reach the bottom and now start moving. For instance, somebody at this point, some people would think that it has reached the bottom, but it still went down. Some people will think it has reached the bottom. Nobody can predict for sure. So you want to avoid timing the market. There's this saying that time in the market is more important than time in the market, meaning that the longer you are in the market, the better for you, rather than time in the market. Then loss aversion. Some people think some people they add more value to losses than potential gain, meaning that, okay, they believe that what's it called? I don't want to use the word panic again, but when the stock market is not doing well, it bothers them more than the potential gain that they are going to get out of it. So because of that, maybe they don't invest, maybe they get out of the market, which is not good. Then overconfidence. Maybe you have done well, maybe you have beaten S&P 500, you have beaten the market, and you are just confident you take too much risk. That could lead to loss. Yeah, I've told people before, yeah, some of my accounts are beating S&P 500, but not every single account. And I can't tell you for sure that every year I'm going to beat S&P 500. Nobody can tell you that. While I can aim at it, I may not always get that. So you don't want to be overconfident. Overconfidence can lead to loss. Then confirmation bias. It's basically the tendency that you believe the information that supports your opinion while ignoring other facts that challenge your opinion. Basically, how do I put it now? You are putting more emphasis on what supports you rather than looking with unbiased eyes. So you want to make sure that you are not biased. Look at all the facts around you to determine, should I invest in this stock or not? Should I sell at this time or not? Then performance chasing. While everybody wants to make a lot of money, you want to get 20%, you want to get 30%. You don't want to chase performance. There are stocks today that in the last 1 year, they've had more than 100% return. But nobody can tell you that they are going to continue at that rate. In fact, I was looking at a study yesterday that says that only about 45% of stocks that have performed well in the past continue in that trend. So you want to look at so many things. You want to look at, yeah, you can look at, it's okay to look at the performance, but that should not be the only thing that you look at. You want to look at what the revenue of the company you are investing in. You want to look at the management. You want to look at what they're even producing, what other people, the sentiment, what other people think about it. Tax efficient investing. I've interacted with many people, especially DIY, and I've discovered that many people don't even understand that when they make returns on investment, they are supposed to pay taxes on it. Uncle Sam will not let you just get make money in the stock market or any kind of investment and go scotch and go like that without paying taxes. Any investment return, there should be taxes. But now, are there legal ways to reduce your taxes or to not even pay at all? When I mean not pay, I'm not talking about evading tax. I'm talking about legal ways to eliminate or lower the taxes you are paying. One thing, let's start with capital gain. Capital gain is when you invest in stock. Let's say you buy 100 units of a stock, let's say you spent $5,000 on it, and by the time you sell it, you realize $8,000. That's a return of $3,000. That's capital gain that you have. But capital gains is taxed in two ways. It can actually be taxed as a capital gain, or it can be taxed as ordinary income. Ordinary income. When I mean ordinary income, I'm talking about when you go to work, your regular 9 to 5 job. The income you get from it is the ordinary income. Now, what determines if the return you get, before I even go into what determines that, now there's this concept of realized gain, unrealized gain, realized loss, unrealized loss. When you invest, again, the issue of investing 5,000 in a particular stock or fund, and you look at it 100, let's say 1 year later, your portfolio has risen from 5,000 to 8,000. As long you are yet to sell that investment, you have not really made a gain. You can see the gain quite all right, but it is called unrealized gain. Again, let's say you buy 5,000 and a year later or a month later, it now becomes 4,900. That's a loss, but it's an unrealized loss. You are not going to pay taxes on unrealized gain. It is when you sell your investment that you now have realized gain or realized loss, and that's when you pay taxes on realized gain. Now, what determines if the gain you have will be taxed at capital gain or at ordinary income? The holding period. For how long have you held that investment? If you have had an investment for more than 12 months, it qualifies for capital gain taxation. If you have held it for less than 12 months, it doesn't qualify. You are going to pay ordinary income tax. That's why before you decide, when you have a portfolio of stocks, before you decide, let's say there's a liquidity in it, before you decide what to sell, it's important to determine the holding period so that you'll be able to determine, like, okay, how much taxes are you paying? Are you paying a capital gain tax? Are you paying ordinary income tax? Now, the next thing is qualified dividends. You've probably heard of people saying that, okay, they want to invest in companies that pay a dividend. Please give me a moment. Yeah, people say they want to invest in a company that pays them dividends. And in actual fact, you can live on, depending on how much I invested, you can live on dividends. I literally grew up seeing my dad living on dividends that he got from his investment. Now, when it comes to dividends, again, when you get dividends from your investment, it can be at capital gain rate. The taxes you are going to pay can be at capital gain rate or at ordinary income rate. And again, what determines? What determines whether, so there are two types of dividends. There's qualified dividends, which you are going to pay capital gain taxes on it. And there's non-qualified dividends, which are going to pay ordinary income tax on it. Meanwhile, I've talked about those two. I should differentiate between the two. Usually, capital gain taxes, there are three levels: 0%, 15%, 20%, depending on your income, right? We will have another session on tax planning where we'll go into, like, okay, the tax bracket for this year. I'll show you how much you will need to make to be in the different each of those levels for capital gain. So it's 0%, 15%, and 20%. Most people are in 15% tax rate, but the very wealthy people in 20% tax rate. the people that have not made much money in the 0% tax. That's unlike the ordinary income that could be as high as 37%, depending on your income. So you want to, it's better for you to be at the what's it called, capital gain tax, to pay capital gain tax rather than ordinary income tax. That's why, again, you want to make sure that unless there's reason, there is an emergency, you want to make sure that your investment has been more than 1 year, so that you pay a capital gain tax on it rather than ordinary income. And then when you are getting in dividends, you want to go, you want to make sure that you qualified for qualified dividends rather than non-qualified dividends. So what's the difference between the two? There are three important things that boxes that you must check to have qualified dividends. Number one, you must have held it for 60 days. Within the last 121 days, you must, within, not the last, within a specific 128 day period, you must have held that stock, not 128, 121. You must have held that stock for 60 days out of a 121-day period, which is before and after. Now, the second thing is that it must come from a domestic or qualified company. Most domestic companies pay qualified dividends. There are some foreign companies that maybe they have an arrangement with the US government that lets them pay qualified dividends. Then the other thing, the last thing is that even though a company is a domestic company, it may not be allowed to pay qualified dividend depending on the kind of what they invest. For example, there's something called REIT, Real Estate Investment Trust. If you invest in real estate investment trust, the dividends you get is not a qualified dividend. Also, if you invest in, like, okay, some limited partnerships, any dividends you get is not qualified dividend. Therefore, you are going to pay ordinary income taxes. So this is especially important for high income people. You want to make sure that you lower the taxes you are paying. You should rather invest in companies that will pay qualified dividends. Our time is I need to run. So traditional versus Roth IRA. When you're trying to determine that, okay, should you invest in a Roth IRA, should you invest in traditional IRA? One of the things you're going to look at is your tax rate now, your current tax rate, and your tax rate in the future when you retire. Like, what you might not know for sure, but what do you think? Do you think that you're going to have be in a higher tax bracket when you retire? If you think so, then it's better for you to get Roth IRA. So what's the difference between traditional IRA, Roth IRA? Roth IRA, you put in the money that you have already paid taxes on, and then it grows tax-free, and then the withdrawal is tax-free, provided that certain other conditions are met, like, okay, you must have had it for 5 years and some other things. We'll talk about that in retirement planning. But for traditional IRA, if you put in money in traditional IRA, there's tax deduction right now. But the implication is when you retire and you get a deduction, you get money from your account, you pay taxes at ordinary income. So again, if you think in the future you'll be in a higher tax bracket, you want to go for a Roth IRA. If you think in the future you will be in a lower tax bracket, you want to go for traditional. Then tax loss harvesting. I've talked about having capital gain, how you pay taxes. Do you know that the losses that you make in the stock market can actually reduce your ordinary income? You have a job, your 9 to 5 job. If you are married, for married filing jointly, any tax gain, tax losses that they have can reduce their ordinary income taxes by 3,000. For single people, by 1,500. So it has now become a strategy that you can intentionally sell stocks at loss to reduce your ordinary income. But not just that. Actually, another aspect of tax loss harvesting is that it can actually offset the capital gain taxes that you have. So it works in two ways. It can offset the gains that you have, and it can also offset your ordinary income taxes. And the good thing is that it rolls over. So let's say you have a loss of 4,000 as a married filing jointly, but you can only take 3,000 this year. The remaining 1,000 you can roll it over to next year. That's why it's important. Whoever is filing, if you're not filing for yourself, whoever is filing for you, they need to take note of all of this so that the following year, the 1,000 that they add from last year, they can take that into consideration and lower your taxes again. I personally do that myself for tax loss harvesting. Now, I thought when it comes to tax loss harvesting, there are rules. One of the rules is the wash sale rule. For you to be able to qualify for tax loss harvesting, you must have had bought the stock more than 30 days before selling it, and also you must not buy it again within 30 days after selling it. So there's this 60-day period that the sale must be outside of before you can qualify for tax loss harvesting. So before you do tax loss harvesting, make sure you do your calculations, or if you have an advisor or a CPA, make sure that they take that into consideration. If you break the wash sale rule, what will happen is that it will be disqualified. Now, portfolio monitoring. Some people believe that all they have to do when they are investing is to just buy stock, forget their password, and just live there forever. No, that's not a good strategy. You want to be monitoring your portfolio. See how your portfolio is doing. Monitor the performance. So it's not just enough to buy, but to be able to monitor your portfolio. And when you monitor, you'll be able to detect when your asset, when it no longer conforms to your asset allocation, then you can consider rebalancing. Then you look at performance measurement. Even though I talked about chasing performance, that chasing performance is not the best. At the same time, you should also be looking at the performance of the stocks you invested in. For example, if your company has been going down for, like, let's say 2-3 years consecutively, you may want to consider reallocating money from that store or company into another company that is doing well. You know that there's an opportunity cost for you, rather than losing the stock, keeping to keep losing the value. You can reallocate the fund to another one that is actually increasing in value. So that measuring performance is really important, rather than holding it forever. Then you constantly review your goals. Are you still in line with your goals? Have you already achieved your goals? Is there a need to change the way you invest based on your goals? Or is there a new goal that could potentially impact the way you invest? Then changes in risk tolerance. If your risk tolerance changes, go back and adjust your portfolio accordingly. And if there are major life events, you have a new child, you get married, there may be a need to change your portfolio. Now, investment management process. This is a process that if you really want to be a successful investor, you should consider following. And we follow it for our clients as well at Iverian Financial. When I meet a new client, one of the first things I ask is, what are your goals? Like, okay, are you investing for, let's say, to make down payment for a house? Is it for your children's education? Is it for retirement and all of those? We consider that to determine what we are buying or where we are selling for you. Then the next thing is assessing your risk profile. What's your risk tolerance? What's your risk capacity? That determines what you should invest in. Then the next thing is to develop an asset allocation strategy. Is it 60-40, 60-30, 10? Is it 90-10, and all of those things? After you have determined your goal and risk, then you'll be able to determine or develop your allocation strategy. Then choose the instrument that you want to invest in. You choose do you want to invest in stocks? Do you want to invest in REIT and all of those things? Then you build a diversified portfolio. Diversification is really important. After doing that, then you implement, you actually do the act of buying and selling. Then again, like I mentioned in the previous slide, monitor and review regularly. If there's a need, you don't need to get stuck with a company that has been losing value for several years. In actual fact, it is possible for a stock to become zero. And once it becomes zero, you don't get your money back. I have at least three companies that I bought that literally became zero and it's gone forever. So you want to avoid that. Those who I bought when I was still when I did not know what I know today. If I knew some ways to avoid to manage risk, that would not have happened to me. Then I talked about rebalancing. Yeah, earlier. Rebalance when you think that your portfolio no longer conforms to your allocation. Now, I would like us to look at this case study. Two people. Sarah, invest 500 every month. Now, how much you invest does not matter as much as how consistently you invest. So I talked about Sarah here that invests $500 per month. Maybe you are not able to afford that. Maybe it is $100 you can afford. Maybe it is $50 you can afford. Maybe $20. The most important thing is to stay consistent. So Sarah has done that for 30 years. She ignores short-term market fluctuation, right? On the other hand, we have John that tries to time the market. He tries to get out when the market is not doing well and tries to determine that, okay, what's the inflection point? When is the market going to start to improve and start buying at that time? So he frequently moves in and out of the investment. Which of these two do you think the portfolio will perform better after 30 years? Of course, it is Sarah. And let me show you something that that confirms that. If you invested $1,000 in S&P 500 in 1990 and you waited till 2023, if you stayed invested the entire period, you will have 27,000. If you missed just one best day, you will have 24,000. If you missed 5 best days, you will have 17,000. You missed 15 best days, 9,000. You missed 25 best days, you only have $5,000. That is why, and best days usually happen during when the market is not doing well. That's usually when the best days happen. Like, okay, during the tariff, when there was tariff, the moment the government said that, okay, we are passing tariff for 90 days, you see the stock market shooting. So it's really, really important that you don't miss out of good days. That's what happened to John then. By missing out of the good days when timing the market, he's not able to get the same return that Sarah got. Now, I'm going to show you, if time permits, I'm going to show you a few more things. But before I do that, let me just talk about Ivorian Financial briefly. At Ivorian Financial, we help people with financial planning. We take a holistic look at your finances and your goals to determine whether or not you're able to achieve your goals. And then we tell you what changes you need to do to be able to achieve the goals. Then we help people with investment management, whether it is discretionary that we actually manage for you or you manage it yourself. We just help you like on what to buy, check your portfolio to see that, okay, is it diversified, and then tell you what to do. We help with retirement planning, risk management. Like I said, that, okay, when I was still learning how to trading and investment, I stopped 3 companies at least that became zero. How do you avoid that? Risk management. Then tax awareness. How do you reduce the taxes that you paid, right? And then wealth management. So again, client first. We put our client first, and we are a fiduciary. Your best interest is what we are after, not even our gain. And we are independent. We always look at long term. We always help our client. Even if you want to invest for short term, we can do that as well. But we look more at long term strategies. Now, let me see if I can show you one or two things, especially when it comes to risk. I know that that is one area where many people are not able to, especially DIY. There is something that okay they don't do very well. Now look at this this is a financial planning for somebody. Um, look at this person. This person actually is a person that doesn't like taking risk. Wanted to preservation, right? But look at the person's account. The person's account 73% stock, 27% bond. That is not preservation allocation. That is actually more risky than the person is able to take. Because of that, I'm able to do financial planning, look at the person's asset allocation and tell that okay, sales equity this much, sell international equity, sell or some buy more international equity, buy more emerging market, real estate, buy all of these things. And you can see this is the currently they have 28% large growth US equity, trimming down to 5.8. They have 23% large value, trimming down to 5.0. They have 3.8% cash, increase it to 25%, and so on. This helps to bring back their asset allocation to preservation, which is 2080. Another thing I would like to show you briefly before we end the session today is allocation. Again, allocation. And I talked about looking at your what's it called? Looking at the performance. I said track your performance. Look at this portfolio. This portfolio in the last 3 months has performed 3.5 3.6 2.36, 5 months, 6 months, 5.47, 1 year 15%, right? And you can see the cost of that portfolio. You know, another thing apart from paying taxes, especially when you buy mutual funds, ETFs, they have what's it called? Uh expense ratio. Yeah. They have expense ratio that you pay. So this is the expense ratio for this account is just 0.24%, which is really, really low. So which is good. And you can see this, we're trying to compare this portfolio to a 60-40 blend. 60-40 blend is 60% stock, 40% bonds, right? You can see that, yeah, this portfolio performs better than 60-40. But at the same time, it's not just the performance. Performance is not the only thing you look at. You look at other things. So you look at portfolio and benchmark and current portfolio. You look at their risk level. Your current portfolio has higher risk level than the benchmark, right? You look at the Sharpe ratio, the standard deviation, they tell you about the risk as well. So, and then the return. Your portfolio has returned 15%, the benchmark would have returned 11%. So it's a trade-off between risk and return. If you want to get this 15% return, then you will take higher risk. If you don't want to take higher risk, you want to have lower risk, then you are going to have lower return. I talked about correlation, how you want to make sure that the items or the stocks in your portfolio, they don't go in the same direction. When certain go up, maybe certain ones other ones go down, right? So now look at this portfolio. This portfolio is not well diversified. There's too much what's it called, correlation between the portfolio. Look at this, comparing two stocks, two funds, FBIFX to PRCOX. Their correlation is 0.9%. Remember, in mathematics or statistics, correlation is between -1 and +1. This is 0.97%. That means they always go in the same direction. That means if one goes up, the other one will go up. If one goes down, the other one will likely go down as well. You want to have, it may not necessarily be negative, but the correlation should really be low. So this is really important. This tells you that, okay, you may need to rebalance this portfolio, right? And it also tells you asset allocation. 78% of this the money in this portfolio is in FBIFX. Maybe you want to sell a little or sell some of it and put more money. You see, this doesn't add up to 100% because there are other stocks as well. So yeah, but maybe you want to reallocate, and then you look at, now these are funds. Each of these funds actually have underlying stocks. So when you are also looking at the diversification, don't look at only this. Yeah, it's good to look at this fund, but look at the stocks within the entire stock within each of the portfolio, which is it. All the portfolio. These are the stocks within those stocks, and look at the different industries that they belong to. These are stocks, these are bonds and cash, to be able to determine how to make sure that you are not taking too much risk, you know. So, and also regional exposure. You can see this portfolio, 68% is in North America, 15% is in Europe, 0.3 in Africa. This is still good enough. Yeah, this is still good enough. So just look at the risk, the chart I showed you earlier. This is it in real life portfolio. You can see the blend is here. This is reward and this is risk. This is taking lower risk, because of it, lower reward. Your portfolio is taking higher risk because of that higher reward. So those are some of the things you determine when you're investing. You actually plan ahead, and that is when you can be successful as an investor. Thank you so much for attending this session. Any question, any thoughts? You can unmute yourself. You can put it in the chat. Go ahead, man.
Yeah, thank you, sir, for the session. So my question, are we going to have a session at some point that can also talk about 529 investment in comparison with regular, stock market investment? Or would you, or if you're not going to have that, would you just enlighten me a little bit if investing in stock market for a child for the purpose of funding their education in the future is more beneficial than the regular 529 educational? So I know that they will have some catch anyway for them to have that specific one, but is it better to just do a 529 for a child or just do like a stock market investment that can be used
Okay.
towards the education in the future?
Yeah, excellent question. Yeah, we will have one session on education planning. I believe the next session, this is investment planning. Maybe the next session is going to be on retirement planning. We'll have tax planning. Maybe after tax planning, we'll go into education planning. But before that, let me just give you like a 30-second answer to the question. 529 and versus regular brokerage account for a child. Yeah, they are for different purposes. Sort of. In the sense that, okay, yeah, if you open a brokerage account for children, you can still use it for education, right? But 529 is solely for education. For brokerage account, especially for a child that is under 18, it will have to be a custodial account, right? So now, for custodial account, any money in that account the child can use it for anything. It could be education, it could be for anything. But for custodial account, it has to, I mean, for 529 account rather, it has to be for education. And why? Why the distinction between the two? 529, it grows tax-free. And when you take it out, if you use it for education purpose, it is also tax-free. Now, there's a recent change, I think maybe 2025, that because one of the things people fear is that, okay, what if I invest in 529 for my child and the child gets scholarship? If I use it for something else, I get penalized or something. The good thing is that, first of all, there are some changes. First of all, you can now use it for K-12 as well, not just for education. Apart from that, you can change the beneficiary. You set it up for a child, the child gets scholarship. You can change it for a relation, right? Apart from that, you can also roll it to IRA for that child. But there's a cap. The maximum you can roll in is 35,000. So you just have to weigh pros and cons. My recommendation would be, and again, I maybe it's not the best to make blanket recommendation. Let me just tell you what we do for our child rather than making blanket recommendation. For me to be able to make recommendation, we may need to talk more about what are your goals and some different things. But what we have for our child, we have regular brokerage account for him. We have 529 for him, and we have the recent Trump account for him. So we have a mix of all of them. Each of them has their pros and cons. But
The
coming back
recent
to
Trump,
go ahead, ma.
sorry to cut in. This recent Trump account, what age do they qualify? Like children born, or is it for any child?
Any child below 18 can open, but
Okay.
there's a 1,000 fund from the government. That is for any child born between 2025 and 2028. If a child is born outside of that range, and if they're less than 18, they can still open. They will just not get the 1,000 seed from the government. But it has
Okay.
its own pros and cons as well. You know, yeah, it has its own. One of the disadvantages it has is that you cannot, when you as a parent putting money there, you cannot deduct it.
Okay.
Unlike 529, right, 529, depending on your state, when you put money in 529 for a child, some states will actually give you tax deduction. For 529, I mean, for Trump account, there's nothing like that.
Okay.
So that could discourage you, but it's also good, especially I believe they're still trying to, things are the way it works will still change a little bit. They're still saying that, okay, maybe I think it's going to become a retirement account, but again, that's just pros and cons.
Thank you. Thank you, sir,
You're
for
welcome,
your
ma'am.
feedback.
You're welcome, ma'am. Any other questions, any thoughts before we end the session today? All right. Thank you, everyone, for attending the session. And if you need help with anything with investment, financial planning, please feel free to reach out to us. And also, we have a YouTube channel that we have videos there that could help you. And on our website, there's a blog on our website where you can learn more. Besides the things we do in this monthly webinar, you can check out our website and our YouTube channel to see more content. All right, thank you so much. The recording of this webinar will be shared with you so that if you want to watch again, you can do so. Wait, did I record? I did. Uh, yeah, I did. Good. All right.